Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are really as fancy as their filings make them sound. And today CBRE Group, or CBRE Incorporated, is in the hot seat. Let's see what they're up to. This report is all about a big money move they just made. They've issued a ton of new debt, basically borrowing a lot of money to pay off other debts. We're talking about a whopping $750 million. Think of it like trading in an old, maybe more expensive loan for a new one that might have a better interest rate or a longer repayment period. This is a pretty common move for large companies, but it is always worth digging into why they're doing it and what it means for their future. So CBRE Group, or CBRE Incorporated, along with a subsidiary called CBRE Services Incorporated, inked a deal on the 5th of November of last year. They're selling senior notes, which is just a fancy way of saying they're borrowing money from investors. They're raising $750 million at an interest rate of 4.900%, and they have about 8 years to pay it all back by 2033. This is a significant chunk of change, and how they use it is always the most interesting part. And here is where it gets interesting. They're not just borrowing this money to have it sit in a bank account. They plan to use the money to pay off debts they owe from a program called commercial paper. This commercial paper program was used to help them buy another company called Pierce Services, LLC. So essentially they're taking out a new, longer-term loan to pay off shorter term debts that were used for an acquisition. This often signifies a company trying to secure more stable, long-term financing after a recent expansion. It's like refinancing your mortgage after buying a new house. They also mention other corporate purposes, which is a bit vague, but usually means they have general operating expenses or other ongoing projects they need cash for. Now, the details of this big loan deal are laid out in something called an underwriting agreement. This is the actual contract that spells out all the nitty-gritty terms between CBI Group, CBRE Services Incorporated, and the banks that are helping them sell these notes to investors. Banks like Wells Fargo Securities, BofA Securities, Citigroup Global Markets, and JP Morgan Securities are involved here, acting as underwriters. They're basically the middlemen who facilitate the sale of these notes to the public, and they get paid for their services. The filing tells us that this description is just a summary and the real meat is in the full agreement, which is listed as an exhibit. It is also worth noting that these same banks have a history of doing business with CBRE Group Incorporated. They've provided all sorts of financial services in the past and will likely continue to do so. This is pretty standard in the corporate world. Companies and their lenders often have ongoing relationships that go beyond just a single debt issuance. It's a sign of a strong, established business connection. Let's quickly glance at what makes CBRE Group Incorporated a public company. Their main share class is the class of common stock, which trades under the ticker symbol CBI on the New York Stock Exchange. This is the stock that most investors would be familiar with, and it is what influences their public market valuation. So, what is the big picture here? CBRE Group Incorporated is a major player in commercial real estate services globally. They help businesses lease, buy, and sell properties, manage facilities, and provide consulting services. This debt issuance suggests they are still actively growing and are comfortable using debt to fuel that expansion. Particularly after a recent acquisition, the 4.900% interest rate on the notes seems reasonable in the current market, especially for a company of their stature. However, it's crucial to remember that all debt carries risk, while the proceeds are earmarked for paying off existing debt and funding corporate needs. Any company taking on more debt increases its financial leverage. If their business performance falters for any reason, the obligation to make those interest payments and eventually repay the principal can become a significant burden. The other corporate purposes line, while common, always bears watching as it can sometimes mask less strategic uses of funds. Looking at this filing, CBRE Group Incorporated appears to be strategically managing its capital structure. They are using debt to optimize their financing costs following an acquisition, which is generally a sound business practice if managed prudently. The key for investors will be to watch their future financial performance to ensure they can comfortably service this new debt and continue to grow their business and profitability. The real test is whether the acquisition they funded this debt for, Pierce Services LLC, performs as expected and contributes positively to their bottom line. If it does, this debt issuance will likely be seen as a smart move. If not, it could add pressure down the line. Alright, that is our breakdown of CBRE Group Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think taking on more debt is a smart move for growth or a risky gamble? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps our channel grow, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching. See you next time.